This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Today on the show, I have two of the four founding partners of Altis Partners, a very successful trend-following fund based in Jersey. Actually, I'm not sure I know the full history, but I believe the island is essentially owned by the Queen. So everyone will have to correct me if I'm wrong on that. Today, Zbigniew Hermaszewski and Natasha Reeve-Gray join me for this conversation. What a great story. Just fantastic insights on their trend-following approach. Not exactly like everyone else's. They do things differently. Everyone's got their special sauce, so to speak. But again, just an inspirational story for people deciding they're going to do it and making it happen. Some timeless wisdom, some great insights. I hope you enjoy this conversation.
Where are you actually at the moment?
I'm in Saigon.
Oh, right, okay, very nice.
Well, we're very appreciative of arranging it slightly later in our morning, so thank you. What time is it there now?
I guess it's 5 p.m.
Okay, it's not too bad then. So
No, actually,
still within working day.
Put it this way: what's terrible is when I have to do a California call. So then they're 15 hours ahead, so it's a nightmare.
Oh my God!
Yeah.
So you're a little bit sleepy in those calls.
15 hours behind. I'm sorry. I've gotten used to it this year, though. I mean, every conversation I've had this year has been from Asia. Most people don't know, but that's generally where I've been for most of this year.
So are you mainly based there then?
For the last 2 years, yeah. I came over here last year for a speaking gig. I was essentially talking trend following to 5 of the 10 largest mutual funds in mainland China, Malaysia, Singapore, Sovereign Wealth Fund. The bank in Hong Kong had toured me around, so it was quite the education. When it was all over, I was like, well, I really don't want to go back to San Diego, so I stayed. So that's.
Well, it's a very different culture and very enjoyable though, isn't it? And I love the food.
Yeah, well, and the thing is you almost can't generalize. Each country is its own. Everyone's different. Some similarities, but then differences. So yeah,
I find that in the United States as well. I find that dependent on the city, that there's a totally different culture and feel.
Oh, for sure. I mean, if you're in Miami versus San Francisco, for example, it's night and day, right?
Yeah, exactly.
Yeah. Hey, but you guys are in Jersey. So some of I had to Google the history. I kind of knew roughly where it was, and I was looking at the politics and the government of it, and it's, an independent entity, but the UK is responsible for its defense, and it's closer to France, and 1,000 years of history.
Yes, I mean, in some ways, Jersey doesn't belong to the UK. It's probably the UK that belongs to Jersey because it's a remnant of the Duchy of Normandy. When the Norman Duke William the Conqueror conquered England, this was part of his domain. It has, an association with the UK. It's actually a crown possession. It's sort of owned by the Queen, if you like.
Interesting.
And there's a strong relationship with New Jersey because that piece of land was actually given by the Duchy of Normandy to, I forget the name of the chap at the time.
Carteret.
And that's why it's called New Jersey.
Interesting. So how did you, I was assuming London-based folks at one point in time, and you make it over to this, what looks like a very pleasant island. How did that transition happen?
We started the business incorporated it back in February 2000 and started trading 2001, July. I had a really great time doing it in London, actually. It was a great base. We were just off Curzon Street, so in the centre of Mayfair, which is a great location, in a very small, dark basement. So that was great for our start, but I think sort of 4 years in, we knew we needed to grow the business. We wanted to attract institutional investors. And it was a really, really expensive, difficult place to do that and also have a good quality of life, because we all, Fish at the time had 2 young kids. Stephen had 1. Alex was well on the way, and I think I just had my first. So we looked at different ways of sort of trying to grow the business, and really, it's very, very difficult. To give you some indication of the difference in costs, our rubbish collection in Mayfair, the annual cost was the same as renting an office here in Jersey. Jersey was close by and very near. Yeah, no, it made a lot of sense, and plus the quality of life. I mean, my commute now is 7 minutes. It used to be about an hour and a half, and I think for Fish it was even longer.
Yes. I mean, we're close to the UK. Don't suffer many disadvantages because we can always get into London. The quality of life is just immeasurably better here.
And the food and wine are great. So being very close to France, we take advantage of that.
Well, you are also demonstrating as entrepreneurs in the fund management space the notion of location independence. People want you for your skills and where you reside. Clearly, you have made the case that where you reside is not necessarily important to the skill that you're delivering your clients.
Yeah, our business is electronic, if you like. We take information in electronically, via screens, via feeds. We speak to people over the telephone. We handle our trading, all our orders, etc., over the wire. Yeah, we could be in Timbuktu if the connections were good enough. But really, yes, you're quite right. We are location independent, and indeed, some of our services are actually run in the cloud.
Let me jump back in time a little bit to some beginnings. Clearly, it's a 4-man team, 4 owners in Altis. The start, the trading start, and I don't know which person wants to speak to this, but the trigger, I'm really going back in time here. The first indication of wow, a system, a model. Was it another influence from a trader in London? Was it a book? Where was the first trigger? Because you both know the typical university structure, you go down the path of the efficient market hypothesis. There's certain training. And still to this day, there's a lot more papers about your kind of work online and stuff, but it's still not something that's really in the universities to a great extent. So what was the trigger?
Well, the trigger for me was not having any money, actually, as a student. And it was, I was a student during the high interest rate times, the late 70s, early 80s. What happened is that with my stipend, I used to put it on deposit at a bank in order to try and gain some interest. Would immediately give them a withdrawal notice for a month's time, which the girl behind the counter always was amused about, and then take that money, which would earn a certain rate of interest for a month, put it into a weekly deposit, and so to try and gain a little bit more interest along the way. And so, I if you like, looked after my money, just tried to make it stretch simply because I didn't have very much. One day I just walked through the library at the university, and a book caught my eye, which was about savings and investment. So I picked this book up and, read through it. So in there was a bit about essentially charting, the stock market, etc. And really I thought, well, goodness me, if it's that easy as the book described, then, perhaps I could do that. And it was certainly a lot easier than much of the mathematics that I was trying to do at that time. I started actually collecting prices of various stocks and, charting them, graphing them, even before I'd actually, got my first job. which was with a stockbroker in the UK. And my interest, right from the start was trading right from there. So it's not something that I'd necessarily learnt or imitated from somebody else. It was really a question of, having to or feeling the need to do that in order to actually make some income.
It's interesting you say that. I've spoken to many of your peers over the years, and surprisingly to me, there is often a network, so to speak, where seemingly people have either worked with or trained with other people. But there's quite a few people that independently, just on their lonesome, came to conclusions and started to go down the more price action driven path. It's interesting because, I mean, you're just mentioning you're in the library, you randomly see something, and that pushes you down the path. Your curiosity said, okay, I'm going down this path. And you're saying the reason is basically you didn't have the money.
Yeah. If I didn't have it, and then, there's a need for it. And the City of London, for me, was a draw in the sense, it was a bit like Dick Whittington, sort of, the streets must be paved with gold, and, I need to have some of that. So yes, I switched, if you like, from a background and education of, physics, mathematics into, the financial sphere. And I suppose in some ways, I might have been one of the first of those types, to come into the city in the early 80s. And it was very interesting. Now, I mean, having said that, I was also realized, how little I knew about it. And so, when you say, one comes up with these things spontaneously, I wouldn't say it was entirely spontaneous in the sense that one was there, one read and tried to gather as much knowledge as possible from as many people as possible. And then it was a question, I suppose, of, dissecting that knowledge, picking out the good stuff, or some elements of good stuff from others, which were, just pure supposition. Yes, I mean, in terms of, coming back to your idea of efficient markets, etc., it's not something that I'd had an education in, really, and it was something that I learned about sort of much later on.
Were you approaching it from the notion of even thinking about something like efficient markets? Or were you just saying, I'm kind of working down this trading system path, and it seems to be working and seems to be successful, and it wasn't until after that you started to say, well, gosh, this is really taking a stab at much of the university foundation in finance?
I think if you have a certain training, and particularly if you have I would say probably a physics background, you approach everything with an open mind. And the whole idea is that you gather evidence, you make measurements, and you draw conclusions from that evidence. Now, typically, you also approach a problem with a hypothesis. So you're not making just random measurements, you're making measurements and observations in order to either support or disprove a certain theory, a certain hypothesis. And for me, that was a case of, can I actually make, a living by trading in the markets? In other words, are the markets predictable? So I was always looking for predictability in the sea of noise around it. What the efficient market hypothesis I suppose that school of thought comes from, is that the idea actually that the markets are largely unpredictable or just completely unpredictable, or that one can't actually make use of that. And of course, I wasn't actually gunning for that answer at all. There's a slight bias, if you like, to one's questions. The conclusions that one drew was that, yes, there's a tremendous amount of noise, but there are small pockets and small elements of predictability, and it's those that, we focus on as traders and, try and take advantage of. Before we jump into,
I want to get into Altis, the styles, the different thinking, the philosophies behind everything, the strategies. The notion of predictability and that word, it's a word that's rife with misunderstandings and perhaps even misuses. But I do know there's many peers, perhaps of y'all's, that that they might want to say, well, this is kind of a bad word. We don't predict. But why don't you define how you're using the word prediction in the context of your world?
It's a term that we use in a statistical sense. It's in some ways, it's like having a coin with a slight edge. One that ends up heads up 51 or 52 times out of 100, and heads down, the other 49 or 48 times. So there's a slight edge to that. Now, if you flip that coin any one particular time, chances are slightly in your favor that it's going to end up with heads. But if you flip it up many times, then the chances are, yes, you will end up net heads up. So any one instance is only very weakly predictable. But if we play that opportunity again and again, as many times as possible, then over time, then that predictability should really come out.
I think it's a fair explanation. I think that helps to clarify how you're using the term. Let me get into the idea of prediction forecasting. Your firm has 4 broad types of market behavior. Why don't you quickly define all 4? I don't want to read them, but I want you to define all 4 for the audience and why they're important to Altis.
So I think, as with the very start, we're quite agnostic as to the actual sources of return, apart from, that they should be quantifiable. That is to say that there is some sort of number that we can pick up, or some sort of categorization that we can pick up, we can study over time, form a hypothesis around, and then test that hypothesis and see whether, there might be something in it, and might be, just different to random. We've perhaps identified 4 broad categories. To a large extent, they're all based around the price action, since this is the most available data that we have. Specifically, and probably the largest driver of returns that we have, is the phenomenon which I prefer to call persistence, but many people call trend following. The background behind it is essentially that change happens over time. Yes, there are instantaneous changes in valuations in markets, but also there's development over time and acceptance by people of a different valuation of a particular commodity. We see basically prices either move to the upside or downside persistently over, quite long stretches of time. And a recent example might be sort of, the asset price inflation that we've seen on the back of quantitative easing. The stock market could have flipped back from its 2008, 2009 lows immediately, once quantitative easing sort of started. But actually, it's taken a long time for that effect, and those monies to work their way into the market and increase those prices. And that's something that, we look for and try and spot these signs of persistence and obviously look into them.
You're looking at persistence from a price data standpoint, though. It's not that your shop is filled with the brightest fundamental minds in the world. You are looking at this purely from a price action standpoint?
For all of our, let's call them indicators, or sources of return, we are looking for data, something in the data that allows us then to take a piece of data and then form a prediction on the basis of that data, whether it's on that data or whether it's on some related data. So yes, past prices we do use, and past returns we use in order to make forecasts of future returns of that or maybe related markets. We don't have fundamental analysts, so to speak, producing those numbers. I mean, those numbers are produced from outside the company. There'll be external pieces of information rather than and factual information rather than the views of people. Having said that, anything that we do utilize in terms of a return predictor or indicator has to pass a sort of a hand-on heart test, and that is to say, it has to pass some sort of test of plausibility. Can we ascribe a reason to that particular effect? And I've described, a plausible reason why trend following might work. I could also describe a plausible reason why, in the short term, markets might be mean reverting, which is another effect that we do look at. There are times when markets get particularly excited. They become very volatile. They move very rapidly, and it's almost like a panic either to get into the market or to get out of it. And this happens not only in financial markets, but, in housing markets as well, for example. I must buy because the prices are going up, and and that sort of house won't be available again, at that price, full stop. Inevitably, this excitement doesn't last forever. When the last desperate person has bought or the last desperate person has sold, the market relaxes back to what might be considered a recent but more sustainable level. Again, that's an effect that we can pick up from price movements. We can look at the relation of recent price movements, the extension of price movements against the typical volatility of that market. And it can lead us to actually, make short-term predictions, which are actually quite different from the long-term trend.
I think you've covered three of those. I'm not sure if you mentioned your thought process behind intermarket relationships.
Well, we don't live in an isolated universe. Any one particular market or any one particular commodity is a commodity that is traded in the world economic system. And as such, there is some degree of connectedness with the other commodities in that world system. So, for example, interest rates. If we take the case of interest rates, falling interest rates inevitably reduce the yield on bonds, reduce the yield on deposits. And so investors basically start looking for other sources of yield and other sources of income. And they'll look at the stock market and say, hey, these stocks offer us a great income compared to what I can get on bonds. And therefore, what we'll do is we'll sell our bonds and buy stocks. So generally, we find that we can find various examples of these links between markets. That one being a particularly strong one. Look to exploit those. So if we do see, for example, bond markets shoot up and interest rates fall, we might expect at some point that stock markets will rise off the back of that. And indeed, vice versa, stock markets fall. Central banks are very, very reluctant to raise interest rates under those circumstances. So again, there's a certain bias, if you like, that slight edge to that coin. That's one of those little edges that exist. It doesn't mean that, it's a sure thing, but it enables us to actually bias our portfolio to take advantage of that.
And again, this is all for your firm, letting the data do the talking.
Absolutely. There is no manual input into our trading on a day-to-day basis, be that the actual forecast of returns, be that the actual positioning, be that the actual trading. Where there is manual input at the end of the day is the decision as to what effects do we research, or what effects do we look into, or what effects do we explore, such as to build, make our model richer and therefore closer to reality.
And I want to talk about portfolio construction, portfolio management. I've seen you make the comment that your strategies are quite different than your peers. Hope that's a fair assessment. And I'd love for you to explain some, if to the extent you can, elaborate. But also the notion, you have the models, the signals, but then portfolio construction is another beast, so to speak. I mean, of course they're related, but they're separate to some extent. So I wish you could just talk some about your portfolio management thinking process, philosophy, and why you see it as different than perhaps other peers.
It's probably fair to say that it is quite different to other CTAs or the traditional CTA managed futures outlook. Let me explain what that is first, and then I'll say, how we do things differently. So a typical managed futures trader, a typical CTA will look at a collection of trades. They will look at a collection of positions. They will look at their action in a particular market. They typically will talk about, this is where I got in, this is where my entry signal is, this is where my exit signal is. when talking about portfolio construction, they'll talk about, well, I take all my positions and I weight them in some way so as to spread the risk between those positions across the portfolio. But at the end of the day, the portfolio is composed and is, if you like, the sum of individual market positions which have been formed in isolation without really any reference to the portfolio mechanic as a whole. So you can think of it as, if you like, a bottom-up approach. For us, it's actually slightly different. We're actually looking at things from the other way round. When we are given a sum of money to manage on behalf of a client, at the end of the day, that client's interest is how that sum of money is going to perform. Yes, they might have an interest in specific trades, but at the end of the day, what their principal interest is, what is the value of my account as a whole? Okay. And that is the approach that we take. What we do is sort of say, what do we do on the basis, what's the best thing to do for the portfolio? Ignore the individual trades themselves. Well, what is the best thing to do for the portfolio? To do that, we have to take one step back and sort of say, okay, well, given our existing positions, given the costs of moving those positions, from, so many lots to, some other number of lots, given our forecasts of where we think those markets are going to move in time, be that, down tomorrow, but, up over the next few months, what is the best thing that we can do? And as soon as you pose the question that way, and pose it to a mathematician, then you'll immediately, the word best immediately implies some sort of optimization. How do we optimize the positioning of the portfolio in order to try and increase its wealth at some point and further down the line? Now, to do that, what we will have to do is position ourselves correctly in various markets, and indeed anticipate how we will position ourselves in the future as well. So we're looking at the evolution of that portfolio in the future. We will then execute various trades to try and increase the value of that portfolio in the future as much as is reasonably possible. The trading for us is, if you like, secondary to the portfolio consideration, as opposed to the typical CTA who sort of say, well, look, I'll start thinking in terms of markets and I'll form a portfolio around it. We go the other way around. We sort of say, look, the portfolio is very, very central to the whole approach. I must get the portfolio right, and the individual trades can sort themselves out. We sort them out behind the scene, behind the portfolio in order to do that.
Philosophically, it's a different way of thinking than I think most people that are exposed to if we just use the term persistence or trend following, it's a different way of approaching it.
Yeah, I mean, in some ways it possibly reflects a different background, a different education. I've come into managed futures, via stockbroking, via trading in bonds, trading in equities. In that, one's been exposed to the way that securities portfolios are managed in a quantitative fashion. And it's that sort of, elements of that approach that one's chosen to use within the managed futures space. Whereas a typical managed futures manager's education, has been the textbook, well, I got in here, I got out there, and, I'll put 0.5% in all my trades, or 1% in all my trades. I just came from it from a different direction, and one which certainly I feel, has stronger fundamental roots, in terms of, mathematics behind it.
Let me shift out of portfolio construction and take even a step back, though, to the individual markets themselves. You're applying the same models to all markets. That's one thing I want you to talk about. But also the traditional portfolio in the fund management world and CTA managed futures, often futures contracts. I'm sure you're right there too. But you also see your models working across equities as well.
We trade futures simply because when we started, these provided certain fantastic advantages. First of all, from my trading background, one started in a fixed income department, one traded many bonds, but these really moved up and down, together. So there are many different shades of grey. I then moved into trading equities and equity options, and equities were, quite colourful compared to bonds, in the sense that, there's a much more diverse movement amongst equities than there was amongst bonds. And then a bit further down the line, I moved to trade, moved into the managed futures space and discovered the world of commodities. Well, if equities were colourful, then commodities were positively psychedelic. These really did offer a very, very diverse set of opportunities. And for me, that's very attractive. If we hark back to the idea of spinning the coin as many times as possible, all of a sudden, here is a set of coins, but actually you can spin you can spin at the same time, and they behave, quite differently. So there's an immediate pickup in diversity. So they're attractive from that point of view. The second aspect is that they are very capital efficient in terms of the amount of margin or capital that you have to put down to pick up some exposure. So whereas trading in cash bonds and cash equities generally required you to put down the entire value of that bond or equity, futures are very capital efficient in the sense that you're only putting down a much smaller amount, the amount of margin which is there to cover you for your day-to-day P&L. So futures are attractive, but that's not to say that the techniques that we have couldn't be applied to other markets. You mentioned that we run the same model across all markets. It's probably fair to say we run the same base model across all markets, and there are specific sector additions to that base model. So the intra-market relationships that you talked about, is very much a case in point. So the same base model is there because, of our, I suppose, belief that trend following is a phenomenon which is present in all markets. And if it is a phenomenon which is present in all markets, then why would you run different models in different markets? There's another argument as well, which flows from a statistical point of view, and that is one whereby a model is always preferable if it can explain, if it has the same explanatory power as a more complex model, if it has a smaller number of parameters. So by treating every market in in exactly the same way in the base case, what we're saying is that we have a more generic model that's likely to be more applicable to markets, going forward, rather than a specific model that might be tuned to a particular market, or rather a particular market's past history. So it's important to us to, make sure that we don't over-parameterize the model to, backfit, past history, and make sure that we actually build models which are generic and are likely to stand up in time.
How far back have you taken your research and testing to see the persistence of your strategies going back in time?
As far as possible is the answer. The problem is that the data is not homogeneous. And in particular, if one looks prior to the early 90s, you'll find there's actually quite a different universe of futures available at that time. The early 90s saw an explosion of financial market contracts, so in particular short-term interest rates, on-market contracts, and stock index contracts. Going back beyond that period, the futures space is much more commodity focused. So one has to be careful about the way one composes, one's historic lookbacks, to make sure that in some way you're actually asking the same question of the same data. Yes, we can see elements of the strategy working prior to the early 90s, but it's on a different portfolio to the one that we're trading.
Gotcha. Let me ask one last big kind of interesting, hopefully colorful for you, colorful for the audience. I mentioned this kind of Natasha and I kind of exchanged some messages early on, which is the idea of collegiality in London. And specifically, there was a handful of very large funds, very similar, systematic. Everyone's got their own proprietary nature, of course, and I'm sure there's much smaller managers as well. So talk about this collegiality. I mean, I'm sure, look, everyone is trying to do well and build a successful firm, and competition is what drives us all. That's all good and well, but there does seem to be, I don't know everything about the scene behind the scenes, but there does seem to be a certain collegiality, a connection amongst the traders that came from London during this time.
Yeah, well, I think we're all friends and rivals, actually. Friendly enough to help each other out, and friendly enough to, encourage and as I say, help each other in various aspects. But at the same time, we all do things our own particular way, and none of us will talk about exactly what we do to any of the other member, if you like, of that, what I would call a European community, but particularly centred around London. It's frankly, it's a small business universe, and if we didn't know each other, it probably wouldn't be that good.
I can only get you to comment so much. I can tell. I'm trying to get it out of you. Your best diplomacy. You just said, Mike, we're not going there.
No, Mike. Actually, though, I think he is actually. I mean, it's a very, very close knit, very collegiate environment. I mean, I think perhaps, and I'm speculating massively here, it comes from a lot of the people that we have grown up with came from very humble beginnings. So we've shared a lot of, pain and struggle and fight to get to where we are. And I think Managed Futures has a lot of those sort of constituents in there. They're entrepreneurs. And I think that shared sort of adversity, if you like, has been it makes you close. That's not to say, as Fish says, people don't go and share their ideas per se, although actually you could argue, particularly in the systematic space, a lot of us read the same text, the same research. There's a lot of similarities too in some of the techniques. So it's not all rocket science, but ultimately there is a collegiality that perhaps comes from that. I don't know, but that's my speculation.
You raise a good issue about the entrepreneurial side, and I think I've seen it too. And I've always felt a kinship in having conversations with some like yourself, the traders that are in the prominent fund management hierarchy. I've always enjoyed the conversations because there is truly that entrepreneurial drive of like, hey, I really didn't start with something so grand, and we have just worked at it and worked at it and worked at it, and it's grown. And I think you're right. I think I've seen that humble trait across just about every prominent manager in the space that I've spoken with.
Yeah. I think that's definitely something that we share actually, and also there's a drive. Everyone's got a little bit of the maverick about them in the sense that they want to do something differently. They have their own mind. I mean, a lot of the guys, Fish and the others have come from very academic, physics backgrounds, mathematics. And they all have their own way of doing things too, which also means that, you collect people around you that feel the same way. And that then grows the business in a certain direction, have a certain flavour, a certain culture about it. Definitely.
Yeah. Well, it's terribly interesting to watch. Listen, I appreciate you both taking the time today to come on and speak with me. Now you've inspired me the next time I'm in Northern Europe that I need to slide over to Jersey and see the island.
Yeah, please do it.
Yes, you do.
Please do. In the summer, it's good. Particularly in the summer, get to the beach. That's the whole thing.
And for anybody that wants to find out more information on Altis Partners, ALTIS Partners, you guys are easy enough to find online, and I'm sure there's probably some additional information that everyone can find pretty quickly.
Yeah, we would hope so.
Anything else we should tell everybody?
Did I miss it? Might be here for another hour.
Did I miss something? Did I miss the most important thing?
No, thank you very much for your time too, Mike.
Thank you for your time. One thing you mentioned about sort of the collegiate atmosphere, I suspect that most of our peers are in the game for the same reason that I am. It's not actually about the making money out of this. It's about the intellectual challenge of succeeding and pulling something out of it. I think that's what we get more of a kick out of than actually making a fortune out of this business. Strangely enough,
money's the way to keep score, right?
Well, the financial aspect helps keep us going. But it's the intellectual challenge in particular that one enjoys.
I appreciate you both taking the time today. Hopefully we can talk again in the years to come.
Yeah, thank you, Michael.
Take care.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.